I'm Phil McIntosh, the Chief Economist at NASDAQ, and today we're going to talk about the economy, how it ended 2024, and things to look out for 2025. So let's get started. And I think if we want to really reframe how we ended 2024, we're in a pretty good spot with a lot of different data. If we look at inflation, although Main Street thinks prices have risen a lot, which is true, the actual rate of change, or the inflation right now, is back down pretty close to the 2% level that a lot of central governments say is their target. So the heat has definitely come out of inflation. If we look at unemployment, we can see that we're also still at very low levels of unemployment. If this chart goes back more than 50 years, and even though we've had an uptick in unemployment and a slight softening of the unemployment market in the US, the rate of unemployment right now is still really quite low. So lots of people still got their jobs, a lot of confidence in the economy, but because we're starting to slow down, not quite as strong in the employment front as it has been earlier this year. So when we look at the GDP growth around the world, we also see that most countries in the end have avoided a recession. The US stands out because it's got really quite strong growth, but really considering the risks that we were worried about a year ago, every economy is growing not too fast, but not too slow, kind of a Goldilocks scenario. And if we look at the inflation story, a lot of people are concerned that maybe there'll be a spike in inflation and that we need to still worry about inflation. But I'm going to put it to you that the spike in inflation that we saw in the 70s, which is what a lot of people draw parallels to, was very different than where we are right now. The 70s had geopolitical crises, oil embargoes, energy price inflation, another shock to the system essentially from wars in the Middle East. What we're looking at in the data right now does not show inflation reigniting like it did in the 70s. In fact, if anything, we're likely to see inflation continue down. And let me show you why. If we look at this chart here, the orange line shows the inflation over the last few years, and you can see the impact of COVID, that grey space where goods price inflation happened when we had the goods supply shortages. We had a lot of stimulus checks, a lot of money in the system, but people couldn't spend on services, so they bought goods. There wasn't enough goods to go around, so prices went up. Then we had the Ukraine conflict, and that affected the energy supply chains around the world. And so the black color is energy prices, which all went up, and that created inflation around the world, which eventually feeded through into the food prices. And so we can see those bubbles of inflation in that period have since faded away. And if you look at the chart towards the right side now, we've got a disinflation and deflation. So the black is deflation. It's actually, prices are falling for energy complex now. The goods prices are falling now, and food prices are going up at a much slower, a much normal rate. Really, the sticky inflation that everyone's talking about is this pink color and the blue color. And so let's look at the pink and the blue color and what's still driving that. And if we look at the pink, it's housing inflation, which is mostly rent prices. And one of the things that we're looking at in the forward indicators here in the lighter color pink is new leases are being signed for almost no inflation at all. And so the rate of inflation that's sort of stuck in that 12-month rolling CPI number is coming down slower, but the outlook for new rents is that they're increasing or not increasing at all, increasing very slowly now. So rent inflation looks like it has downside risk, not upside risk. It's just been very slow to get there. If we look at the blue color, it's services inflation, and a lot of services is wages. It's the wages that people are getting paid. And so in that post-COVID sort of explosion of activity, a lot of wages went up. But what we're seeing now is that trend of wages, the dark blue line here, is definitely trending down. And if we look at one of the leading indicators for this data, which is the quits rate, a lot of people are pretty nervous. They don't think they can quit one job and get into another right now. And that usually means that wage pressure is going to keep coming off. And so the outcome for inflation in wages looks like it's going to be reducing, not increasing as well. So there's a third tailwind or headwind that we haven't really talked about, and that's demographic. And this is a much longer term headwind than the other two data points that we looked at. But if you think about this chart, it's looking at population change. And when we look at Japan, which is the red line, its population started to shrink back in the 90s. When that happened, the government put rates to zero-ish, and it didn't stimulate the economy. So even having zero interest rates back then didn't stimulate a shrinking population's economy. If we look at the light blue line, that's Europe, and we see the same thing happen in 2010, and they put rates to negative levels, and that still didn't really stimulate the economy. So if we look at the US population has been growing slower as well. And as that happens, we have an older population, and older people tend to downsize houses, hang on to cars for longer. They don't need to expand their houses, extend their houses, buy new white goods. And so the level of activity in the economy is naturally just a lot slower. So the amount of interest that you need to create a slowdown in the economy is lower as well, which is why Japan and Europe weren't able to stimulate their economies with zero and negative interest rates. So that all gets us to this thought of where should interest rates be right now? And the Fed actually does create a neutral rate of interest, what we could call a Goldilocks zone for interest rates. And you can see it on this chart. It's kind of been trending down over decades, a lot like that demographic chart. And it doesn't have a very strong positive real interest rate these days. And that's because of the demographics aging. If we look at the red line, that's where the real interest rates have been traveling. And you can see, even though we've seen rate cuts in that recent period, we're still not down into that Goldilocks zone. So where rates should be, even if we just don't want to stimulate or contract the economy, is in the Goldilocks zone. Where we are right now is still contractionary. So we're not at the neutral rate of interest yet at all. We should expect rates to come down perhaps quite a bit, perhaps 1.5% to 2%. And that's what we're looking at here in this chart. So if we look at Europe, which is the blue color, you can see the forecast from the market there is that their interest rates do keep coming down. And obviously, interest rates around the developed world are coming down already. The forecast is for rates in Europe to keep coming down quite quickly. But actually in the US, that red line shows that rates are expected to keep coming down, but maybe only 1%. And maybe slower than we actually thought a few months ago. So the outcome right now, what the market is telling us is we're going to have higher interest rates for longer. The 10-year is actually pricing over 4%. So we could probably expect a 4% interest rate if we're lucky at the end of this year, which is a bit different than what we were thinking maybe 6 months ago. Obviously, a lot could change in 2025. And if we think about the big change, it's the US election at the end of this year. The election of Donald Trump, it creates a lot of different policy potential than we've had in the past 4 years. And so one of the things I think sort of shows us how to think about Trump 2.0 is Trump 1.0. And even when Trump was president the first time, we had a lot of trade policy uncertainty. We had tariffs, we had tax cuts, which are kind of similar to the policies that he's proposing in his second term. So one thing I guess we can be sure of is we're probably going to have uncertainty, and that's what this index here seems to indicate, is that uncertainty, especially on trade, is going to be higher, and that's going to raise a lot of different, I guess, concerns for companies and potentially uncertainty in terms of which stocks are winners and which countries are winners out of these policies. If we think about Trump's policies at a high level, there was a lot of tax cuts being promised on the individual side and also on the corporate side, so everyone's going to have more money in their pockets. That's going to be paid for primarily by tariffs. So we can talk about how tariffs will change the economy. Also by government efficiencies, the Department of Government Efficiencies, or DOGE. It may lead a net expansionary budget. It probably will if you look at a lot of economists' forecasts. And so the net result is still a lot of net cash creation in the economy and increased demand. If we look at what happened with the first Trump administration, like we said, he did tax cuts. And when that happened, corporate profits went up. You can see that in the blue in this chart. Then he also started to put tariffs on China specifically. And when he did that, corporate profits actually struggled. So potentially that's one of the things that we can start to expect to happen as we see the tax cuts and the tariffs being rolled out in this administration. I guess one of the things that the market's focused on right now, though, is tax cuts, looser regulation, a lot of things that are going to save companies money. And so if we look at the left-hand side of this chart, when the tax cuts happened in the first Trump administration, there was an increase in profit for almost all sectors, but some sectors benefited more than others. Financials, consumer names tended to benefit more than energy and healthcare names. If we look at the modeling coming out of a lot of economists at the moment for a tax cut in the second administration, you see kind of similar outcomes. The small cap companies are probably going to benefit more than the large cap companies, the Russell 2000 versus the S&P 500. But again, consumer names, financials probably benefit a little bit more than energy and healthcare. But basically every sector will benefit from tax cuts. They'll get more money left in their pockets to distribute to investors. The other thing that people are talking about is lower regulation, and there's a lot of people saying that during Trump there was a lot less regulation, a lot less costs of companies having to comply with regulations, especially compared to the Biden administration. And so if that's going to repeat itself from a company's perspective, a lot less money has to be spent on adopting new procedures to these new regulations. The third thing that the market's thinking about is whether M&A could pick up, because the environment during the Biden administration, if you look at this chart, tended to be negative for mergers and acquisitions, made it much more difficult for mergers to happen. And you can see that in this chart. The level of mergers in the bank sector has actually been lower than it was even coming out of the credit crisis, when a lot of people were uncertain about different banks' balance sheets. And so if we see a bounce back in merger activity, obviously prices for companies that are going to be acquired will go up as a merger premium. So that's starting to get priced into stocks. And if we look at what's happened to stocks since the election, you can see almost all sectors are up. So the combination of things that we just talked about, less regulation, lower taxes, maybe some merger and acquisition premiums being built in, are making most sectors go up. So healthcare and energy sort of down the bottom there, not doing so good. But financials and consumer names, industrials right at the top, have been doing much better because of the combination of all those factors. Let's talk about some of the policies, though, and how they might actually play out. So how you're going to think about different companies, different countries, who's going to be winners, who's going to be losers. And if we think about tariffs, the first thing a tariff does is it's a tax on inputs, goods coming into America. And so it's going to increase the input prices for companies. And a lot of companies are going to try and pass those price increases on. So that's probably going to create some inflation, even if not 100% of the tariffs get passed on to consumers. The next thing we're going to see is retaliatory tariffs. Most countries aren't going to sit back and let this happen to them. We're not going to let themselves be hurt by tariffs without reacting to America. And so we're going to get some retaliatory tariffs. Then companies are probably going to look at their supply chain, because if it's costing more to do global trade, they might want to move their supply chain around to countries that are less tariff taxed, or at least consolidate some of their supply chain. And if they do that, then they're going to have to find new workers in new countries. And so we might have some skill shortages, at least in the short term. So let's think about how that could play out. This is an interesting chart, because when you think about tariffs as a price increase mechanism, if all the tariffs happen at the very same time, maybe the price of all goods goes up, but then they stay at the new price because the tariffs are fixed. And so it's a short-term bounce in the tax rate. And in reality, if we're taxing goods, goods are about 20% of the US economy. And if you put a 10% tax on all of them, it's not actually that much money to add to the tax bill and the prices of goods. And so we might see a relatively small bounce in inflation, but it'll fade away over time. And so the inflationary impact of tariffs themselves might not be as big as a lot of people are fearing. If we think about the retaliatory tariff problem, we can look back again to Trump 1.0, because in that period, when we taxed the Chinese and we put tariffs on some of the Chinese goods, the Chinese government turned around and taxed US soybean exports. And so what you can see in this chart is when the soybean tariffs were put on, the demand for US soybeans almost halved, and the demand shifted to Brazil. And actually that improvement in Brazil and the degradation in US exports of soybeans has persisted to this day. So you're going to see supply chains change as people try to adapt to paying less tax and getting cheaper goods after tax costs. One of the things we can see if we look at how tariffs have sort of affected global trade is, again, if we look at the first administration of Trump, when those Chinese taxes came on, even through the Biden administration, you can see the red line in this chart. China's exports to the US have fallen relative to all other countries, and they've continued to fall even through the Biden administration. So companies have resourced their inputs to other places where the tariffs are lower. And you can see some of the winners here are countries still in Asia and pretty close to China. If we look at Taiwan and Vietnam are beneficiaries, but maybe also Mexico, nearshoring closer to the US, and to a degree, friendshoring, so getting Europe and some of their manufacturers and bringing goods in from Europe instead. So tariffs can change the supply chain quite significantly, and in the ways you'd expect. If it's more expensive in one country versus another, it's going to create winners and losers. So which countries might be those winners and losers? An interesting way to think about it, at least to start with, is where is the US's big trade counterparties? And so the size of each country in this map is how much trade we have with those countries. And the color red, the darker the red, the more of a deficit US has with those countries. If it's blue, actually the US exports to those countries net. And so the expectation is that obviously China has been talked about for higher tariffs, and since the election, Mexico and Canada have been focused for potentially higher tariffs. And if we look at those three countries, they are all quite red and relatively large. And so we may end up with a more bilateral impact of taxes on country by country basis, based on how much we need to change the supply and demand imbalances with these countries. So the redder countries, the larger countries, it includes a lot of Asia, could be more exposed to tariffs and reduced exports to the US. Latin America, for example, could actually be relatively lower focus, at least initially, the way the tariffs are implemented. And so if we think about that, there's obviously going to be winners and losers around the world. An economist will tell you that adding tariffs, reducing global trade, will net reduce GDP because countries are going to be producing less to export. Resources are going to be allocated to other industries where they're not so well suited, and so you're actually going to decrease GDP around the world. This is an Oxford Economics forecast, and it does show that China and Asia-Pac, like that previous diagram showed, are probably going to be more affected by tariffs than a lot of other regions around the world. But the US could also be affected with retaliatory tariffs and just with the reallocation of resources into the US, where maybe some workers are going to be pulled out of high-value industries into low-value industries to shore up the supply chain for some of those industries that we're going to need to replace. There's also a policy of changing immigration, maybe deportation of some immigrants in America. And so that is potentially going to be inflationary too. And I think the way to think about that is actually to look at COVID, because COVID created worker supply chain problems as well. If we look at this chart, the red line shows the recovery after COVID of the manufacturing sector when we had stimulus checks being paid out, but everyone was still on lockdown, stuck at home. So they couldn't spend on services, but they could spend on goods. So the manufacturing sector was quickly growing. It recovered above the horizontal line really quickly and hired back a bunch of people. Then when we got vaccines, you can see the services sector also started to recover really quickly, and then it needed to hire people back. So in the US, we had a huge demand for labor in that bubble period, but we didn't actually have a lot of workers coming back into the workforce yet because not everyone was vaccinated and not everyone was comfortable coming back. And so we had a lot more demand for workers than we had supply of workers. It's interesting where we are right now if we follow those lines down. Manufacturing has been in recession for a good year and a half, maybe 2 years, but the services sector is still growing. It's not growing as quickly as it was pre-COVID, but it's growing enough to hold the US economy up because actually the services sector is about 80% of the US economy. But let's get back to the supply chain of labor problem. What's interesting about that period where the services sector was trying to hire and the manufacturing sector was trying to hire is if you look at the blue line in this chart, we had 2 jobs for every 1 person looking. There's a lot of normalization that's happened in the last couple of years. We're now back closer to 1 job for every 1 person looking, but when that period of like multiple people look, or multiple jobs for every person looking was happening, a lot of people were job hopping. And so we had what's called the Great Resignation. And if you look at this chart, the purple line shows the salary changes for job switchers. So those people that were able to switch from 1 job to another and back to a 3rd job were actually able to see their salary go up and up quite quickly, even more quickly than job stayers who also saw salaries go up because of the lack of supply of labor and companies wanting to hold on to the people they did have. And so wages went up. That was bad for companies, but it was great for workers, especially people who could job switch. The good news for companies is the trend has come right back down. And so the rate of labor growth is slower, like we talked about earlier. But you can kind of see the impact of having supply chain and labor shortages in an economy. If we look at the US economy right now, you can see some sectors still haven't completely backfilled all of the workers they've been missing. And so if we look at hospitals and we look at leisure and hospitality, and we look at construction where there's a lot of spending on chips and actually, ironically, trying to shore up the supply chain of the chip manufacturing and battery manufacturing sectors in the US, they are still trying to rehire workers. What's interesting about this chart as well is you're right down the bottom there, manufacturing, which has theoretically been contraction for almost 2 years, has not really done any layoffs. And that's because when you talk to manufacturers, they're worried that if there's an uptick in manufacturing, there's not that many workers out there for them to rehire, so they don't want to lose who they've got. So that's kind of where the US economy is. It's still in a pretty good shape, and for workers, they're still pretty comfortable with their jobs. If we think about the deportation issue, where are the unauthorized immigrants and what sectors are they in? And it's probably similar to some of the sectors that saw the quickest recovery from COVID. So it's construction, it's laborers working on construction, on gardening. You can see it's a lot of people in relatively low paid industries. So if those people do get deported, what's that going to mean for wages? What's that going to mean for inflation? And what's interesting is it kind of depends on how many people get deported. So there's a couple of different estimates out there. One estimate looks at if 8+ million people get deported, which is a phenomenally large number for a country with just over 300 million people. That would go back years looking at people that have crossed the border. It'd be people that are now employed in jobs and contributing to the economy and paying taxes. So maybe politically that's not actually where we'll end up. But if we lost that many workers, you can see the inflationary impact is pretty significant because there's a lot of people going to be missing from the workforce. What's probably more likely is to look at the new people crossing the border that haven't found jobs yet and just sending them back. And even if that's 1 million people, because they're not working yet, it's not going to disrupt the supply of labor half as much. And so the forecasts have the impact on inflation much lower, maybe holding inflation a little bit higher for longer, but really not making a spike in inflation. So when we put all this together, what's the consensus and what are experts saying about 2025 and all of the potential Trump policies? And so this chart, it's pretty consistent with what a lot of other economists are forecasting, and that is that the tariffs are probably going to happen first. It's something that can be done by decree, presidential decree, and they are going to initially increase prices like we talked about. Then we're going to have tax cuts, and tax cuts are going to increase the ability of people to spend on things without necessarily increasing productivity enough. And so that could create demand push inflation like we saw with the COVID supply chain shortages, whether it's companies having more money, which is the blue color here, or consumers having more money, which is the red color here. There is likely to be more spending in the economy. And so we're actually going to have demand pushing inflation higher as well. And then if we eventually have some deportations or immigration restrictions that make it harder for companies to hire in and create more production, that could keep inflation higher longer. So that's why a lot of people are saying a lot of these policies are inflationary and how they'll sort of factor into the economy. The left-hand side, though, look at that axis. It's not percentage points of inflation. It's a fraction of 1%. So it's not as big as a lot of people are fearing if we look at these forecasts. What's interesting is thinking about the impact on GDP as well. And so obviously increasing demand, the consumer drives a lot of US GDP. We've seen that this year. So that's going to be positive for GDP. Tax cuts generally, whether it's for the consumer or for the companies, is going to help grow the economy. On the flip side, though, we've talked about how tariffs may slow down the economy. It's definitely going to slow down economies that can't export as much. So that's going to potentially go the other way for America and reduce GDP. And depending how much the immigration restrictions impact companies, that could reduce their ability to produce as well. So there's going to be a balancing act between the consumption benefits and the sort of the detractions coming through GDP, whether in the long term these policies end up helping GDP grow or holding it back just a little bit. If we think about what the market's saying, though, the red line here, again, is looking at interest rates in the short term. So the Fed's been cutting rates, and the expectation is they'll keep cutting rates. The expectation isn't that they get right back down to that target rate we talked about anymore. They're going to get closer to a 4% rate. And what you can see happening in the black line is the longer term interest rates, which are sort of saying We got down to 3.6% on the 10-year. It's gone back up above 4% to 4.3, 4.4%. That is saying that over the long term, we are going to have higher interest rates. And so because of the impact on inflation, because of the impact on growth, we're going to have stronger economy, stronger inflation. That means interest rates really probably can't afford to come back down to that 3% level, at least not as fast as we were thinking 6 months ago. So that's what the market's saying. What does that all mean for stocks? It's interesting what that means for stocks. If you look at the performance of global stock markets this year, pretty much every market around the world has actually had pretty good performance, whether you're talking about Asia or Europe or the US. Whether in the US we're talking about small cap, which is the green color there, or large cap, which is the orange and gold color there, almost all the markets have been going up. And there's a couple of reasons for that. If we look at the difference between the orange color here though and the light blue color, the NASDAQ 100, which is a more concentrated, I guess you could say, mega cap index, it's been going up even more. And so what's been driving stock returns is actually earnings. This chart is looking at the growth of earnings in each of those indexes. And so you can see that the NASDAQ 100 companies themselves have been growing earnings much more strongly than the S&P 500 companies, which have been growing earnings much more strongly than the other countries around the world. And actually, if you look at US small cap, that green color, they have been in an earnings recession. So the dispersion of equity market performance is kind of explained by earnings. It's been fundamental. If we look at earnings and we divide it one more step, the very left-hand side of this chart shows that those MAG 7 stocks, the 7 stocks in the S&P 500 that we list there, have been growing earnings much more quickly than the rest of the S&P 500, which is the second bar on this chart. You can also see there's been some margin expansion. The orange dots in this chart show the performance of each of these markets. The green bars show the growth in earnings, and the blue is the difference. So as interest rates have come down, we've seen some margin expansion. So falling interest rates has been good for stocks. But really, the earnings in those MAG 7 stocks have been driven by the artificial intelligence trade and investment that's going on. So you've got NVIDIA, which is obviously making a lot of these GPU chips. You've got Microsoft and Amazon and Google, which have cloud compute facilities, which you need to refactor these LLM models. And then you've got companies like Tesla and Apple, which are probably the first places that companies are going to touch AI, that consumers are going to touch AI. And so they're going to be beneficiaries initially from consumers using AI as well. And so their earnings have all been growing. When we look across the spectrum, you can see the S&P 500, that 13% rate that's been growing. So there's been a broadening of earnings gains across the S&P 500, a recovery for more companies in earnings. But when we get to the far right-hand side, you can see that earnings recession in small cap. So what is going on with small cap? Why are they so different? And actually what's going on with small cap is more linked to the economics that we've been talking about. If we look at the balance sheets of small cap companies versus large cap companies, you can see on the left-hand side of this chart, not many large cap companies have much floating rate debt. So the increase in interest rates that the Fed has orchestrated as a monetary policy measure hasn't really affected large cap companies much. That's not the case for small cap. About a third of the debt that they have is floating rate debt. So as the Fed has increased interest rates from 0 to 5, the small cap companies' interest expense has also gone up by at least 500 basis points, sometimes more. So that's important for rates to come down, and to come down pretty quickly, because small cap companies are paying more interest than large cap companies. We look at next year, actually the amount of fixed debt that's rolling is pretty consistent, but if we don't get rates down in the next 12 months, we start to see a difference again. So large cap companies have about a third of their debt expiring in the 4 years after that, but small cap companies have the majority of their debt expiring. So if rates are higher for longer, these small cap companies that have seen increased interest costs are potentially going to see an increased cost of capital as they roll their fixed rate debt as well. So small cap companies have been hurt a lot more by the Fed's interest rate policy, and you can see that in this chart. So this is looking at historically the rate of interest expense as a percentage of EBIT, or earnings before interest and tax. And for large cap companies, we really haven't seen an uptick, even though the Fed has increased rates pretty significantly. For mid cap, we've seen an increase, but not to previous record levels. For small cap, they are basically at record levels. If we ignore recessions where it's earnings that fall rather than interest costs that go up, you can see the interest expense now for small cap is about 50% of their EBIT, and that's stressing those companies and making it really hard for them to have an earnings recovery. So these companies would really benefit from rates falling. What's interesting when you survey companies, and even when I go and visit some of our favorite listings, is they don't seem to talk about interest costs as much as they talk about other things that they're concerned about. And so this survey really does show what they talk most about. They talk about inflation as well. They also talk about labor costs and labor quality. They're finding it really hard still to find skilled labor for jobs that require skilled labor, and the costs of labor are increasing. And perhaps the chart that shows this best is this one. And what you're seeing is input costs here, the orange line, went up really quickly and they kept going up. It's a bit like that Main Street inflation chart at the very start. 22% increase in costs of inputs already. And this is before we talk about tariffs for companies. On top of that, wages have actually increased even more, 25% increase in wages costs. So if you're a small company with a lot of staff, that's really hurting your bottom line because your expenses have all gone up quite a lot. So as we head into 2025, what should we be watching for? I think the most important thing to think about is how the consumer health is, because if we look at the reason why the US economy has been stronger than most of the economies around the world this year, it's because of the consumer recovery. And this chart shows it. So this is looking at consumer spending on an inflation-adjusted basis. The blue line is the US. With those stimmy checks, we recovered from COVID really quickly. And then even with inflation, we've increased spending by 15% more. And so that's driven the US economy. The reason that the consumer has been spending in the US is for a bunch of reasons. They seem to have locked in fixed mortgage rates, and so they haven't actually been affected by the Fed's monetary policy as much as they normally would. We've seen real wage growth. We just saw that in the last chart. We've got strong employment, and so people aren't worried about losing their jobs. Even if people have savings, because interest rates are now higher than inflation rates, we've got positive real interest income. And also house prices in the US are high, so people's balance sheets are really strong. So the consumer in the US has really helped drive the US economy much more than the green and the yellow chart that you can see there for the European region. And that does have signs that it can continue. What's interesting is looking at the labor market, and we talked about how low unemployment is, but at the same time, we noted that it's increasing. And so that's a concern. If we look historically at places where that blue line has started to increase, it almost always bumps into one of these gray vertical channels, which is a recession. And the logic for that is that if people start to lose their jobs, then they're going to stop spending. Maybe some of their friends worry that their jobs might be next and they slow down their spending. Companies earn less money. When companies have less money, they can't afford to, they don't make as much profit, so they might need to cut some of their costs, which might mean laying people off, especially if there's less demand for their products. And so you can have a feedback loop that gets created where a little bit of an uptick in unemployment and layoffs creates a really quick increase in unemployment, which leads to a recession. That's the intuition. An economist called Claudia Sahm basically found that statistically, if you have a 0.5% increase in unemployment in half a year, that's when you get that feedback loop start. And actually that happened back in September in the US when we hit the peak, the most recent peak of unemployment in that blue line. What was interesting was that the market worried for a little while and has since calmed down. And that's because at the moment, the unemployment increase in the US has been driven by quite different factors than normal. If we look at this chart, what's actually happening, if we focus on the purple line, is people are seeing those higher wages and coming back into the workforce in force. We have a really strong increase in the participation rate. So it's people coming in and looking for jobs rather than people being let go and looking for jobs. So when they come in and look for jobs and they get hired, then all of a sudden they're earning income and spending more. That's totally different impact on the US economy than the alternative, which is people losing their jobs. And if we look at this data, what you see is so far, there really hasn't been material increase in layoffs. So the red line here, we're looking across more than 2 decades, is pretty close to all-time lows in terms of layoffs. So the job market is weakening, but only a little. It's kind of in a Goldilocks zone. Even the long-term unemployed, which is the black line here, is getting a little bit worse, but still really quite good. And so the consumer has a lot of reasons to keep spending. That's why the outlook for the US economy is still pretty good. I guess the good news in 2024 is most countries avoided recession. And I think the one thing we've got to think about for 2025, there is going to be some uncertainty. There's going to be some supply chain changes, and there's probably going to be winners and losers. It's going to be an interesting year to be a stock investor. This has been Phil McIntosh, Chief Economist at NASDAQ, looking at the outlook for 2025.